Well, good afternoon, everybody, and welcome to the October 12th Oktoberfest Part 2 session of Bull Sessions. My name is Mark Robertson. Ken Kavula is on the road, return travel from a vacation and a brief break down somewhere in the southeast, and we look forward to his return. But in his absence, I have a few other people in the back room, along with our traditional guest damsel, Kim Butcher. Good afternoon, Kim. Hopefully the sound quality holds in there for you.
Oh, it's much better. Right now it's great.
Cool. Maybe having the record on makes a bit of a difference. So, and the storms are missing you?
Right. Well, it's 90 degrees here. Yeah, sunny.
We're also joined again, and I do not believe he's wearing lederhosen again this afternoon, but we're also joined by Sean Mays of Pennsylvania. Good afternoon, Sean.
Good afternoon. Sorry to disappoint everybody that I'm not wearing the lederhosen today.
And all right, and also joining us, it's not on the slide, but I'll fix that, Matt Spielman out of Houston. Good afternoon, Matt. You may be muted already.
Good afternoon, Mark. Hi, everybody.
Okay, so let's go ahead and get underway. Like I said, we've got a lot of turf to cover here. This gentleman named Brian Feraldi is a freelance writer. He is interested in investment education. He has written for The Motley Fool. I suspect that we will actually have some interaction with Brian in the not-too-distant future. But for now, we're going to actually use one of his presentations for some highlights, and we want to continue this discussion of the discovery of small company or faster-growing company ideas throughout Oktoberfest as we wind down towards Halloween, 19 days away now, I think. And Ken is already concerned about costumes and all that kind of stuff, so we got to keep him on his toes and concerned. So let's go ahead and get underway. Get the legal paperwork out of the way here. No investment recommendation is intended. We will be talking about real companies in real time. This is all about an educational demonstration. Everything is for illustration. I'm going to say the word demonstration again. What we seek to demonstrate is the lessons learned and what I consider to be the powerful potential of investing in the same manner as the modern investment club movement. There's over 8 decades of legacy of success and helping people become less, frankly, frightened of investing and learning about what it can mean to own a wonderful, successful investment for as long as it makes sense to do so. That's what this is all about. We're going to basically be talking about our opinions about these methods and analysis techniques as interpreted by those of us at Manifest Investing, and certainly consistent and complementary to the traditional lessons of better investing, also known as the National Association of Investors, for many years. And we think that everything is consistent and complementary. So you will hear opinions from us. Please do your own review of any company and make your own decision. Do your own homework, please. We will try to remember to remind you if we own any of these potential companies that we're covering in our portfolios. We do a monthly program at Manifest Investing, co-sponsoring with the Mid-Michigan chapter of Better Investing, known as the Roundtable. It's always on the last Tuesday of every month at 8:30 Eastern Time. It's a webcast where we simply share 3 or 4 ideas and show how we basically do the analysis of those as opportunities. If you'd like to be added to a reminder list for that session, just send an email to nkavula1@comcast.net, and you will not be inundated with email. Natalie will simply remind you of when those events are going to take place. If you'd like copies of slides, or if you have follow-up questions, or even more importantly, suggestions for future topics here, we do this every Tuesday at 2 p.m. Eastern Time. Send an email to markr@manifestinvesting.com. You guys are already coming up with some fantastic ideas and suggestions for future coverage. All right, let's go ahead and keep pressing on. This is basically what it's about. We started doing this about 1.5 years ago now, where we simply come together and kick around something of current interest. So today we are going to be talking about the good reasons to ignore PE ratios. Now he's being a bit playful there. There are times to ignore them, and there are times not to ignore them, and then we'll talk about that briefly. But we are then going to continue our coverage of building out our list of best small company candidates for the list that we basically lock in every year at Halloween. You can see some of the other are bolded in there that we're going to be covering today, and the rest of those topics are among future topics that we'll be covering. And then, Sean, I did want to point out that today is that actual anniversary of Oktoberfest. And I think you actually have been to the home of this, right? Didn't you actually spend time in Munich?
I unfortunately have not gotten to Munich, but they definitely celebrate Oktoberfest everywhere else throughout Germany. So I just missed the big portions of it, but all the other towns are enjoyed as well.
All right, so we'll tip a glass or a...
I can say I've been there at Oktoberfest.
Cool.
And they have those big beer steins that you see. That beer stein holds 3 cans of beer. I learned that the hard way.
Ouch. All right, let's press on. Speaking of beer. All right, here's our graphic for the week. We're going to talk about S-curves. You hear people like Kathy Wood talk about them all the time. It's something that we have talked about, over the decades at Better Investing and Manifest Investing. The reality of you really need to figure out where a company is in its life cycle, and it's an important consideration in the analysis of any company. And obviously, we like to give them some time in existence and kind of proving themselves, perhaps surviving a recession or a big correction. And then we really do look forward to that time when they basically become up straight and parallel and head into maturity and basically reward somebody who recognizes opportunity fairly early in that expansion stage. Much of the presentation today is going to be about stuff towards the left-hand side of this chart, which is something that we have talked about at length. It's a Hugh McManus favorite. Every once in a while, Kim will sneak in here with one of these, and it's an area of tremendous opportunity, and we want to take a closer look. Any thoughts on any of this, guys?
It's just finding them. That's the big problem. Finding the one that's going to be able to go into that huge expansion mode for you.
Yep. All right. Well, we have been finding them for the last 6 years, and I'm knocking on wood, if you can hear that. We actually have expanded our lead. We have only 19 days to go, so Ken might actually let me whisper about this a bit. We're approximately 10 percentage points ahead of the Wilshire 5000, so we really hope we're going to get a 7 repeat this year. And it just, again, underscores this notion of you can go out there and shop for companies. You can go out there and shop for the best small companies, and you don't have to settle for low quality companies when you do that. You want to be just as demanding, as Ken often says, of your small company opportunities for study and ownership as you would anything else. And it can be done. It can be a little bit dicier. It can be a little bit more dangerous of a minefield, but done carefully, it can be done. So you can actually access that public link at the bottom if you want to follow us home. 18 of the 20 are still actively traded, and we had a couple taken out at a premium, which has helped us a little bit. But you can actually access that public dashboard using that link at the bottom of the page if you want to track it all the way home with us between now and Halloween. All right. Just a reminder that we are out there looking. The Red Rabbit's our mascot. We're basically out there trying to find these opportunities, and these are our favorite sources that we're covering during Oktoberfest, or Red October, if you want to think of it that way. We have covered a number of these already, and we can continue to monitor them for faster growing company or our smaller company opportunities. And today we'll spend a little bit more time with Microcap Club there to the lower right, along with a couple snippets from StockTwix, although that's going to be deferred, I think, till next week. But we do have a Reddit slide and a couple others. We will continue to dig into some of the social network opportunities that are out there. But these are our favorite sources, and we'll be winding up the month with a few of these. All right, here's a look at kind of the 20 at the top of the list right now. It's kind of a king of the hill situation. These are companies that are kind of in a leadership position In order to make the list, you basically need to be double-digit growth. You can see a couple of those are marginal, and high quality, with a return forecast that is above average, a superior return forecast. And you basically have to land, with a double-digit growth rate in the top 1% of all companies covered at Manifest in order to make this list. Now, we do have 3 or 4 regional banks on here. They're not all going to survive. They'll come off the list and be replaced with something else, but pretty good representation top to bottom, and we will be covering and auditing and verifying every single one of these and over the next 19 days as Halloween approaches. Any comments or concerns about any of these, Sean or Kim or Matt?
I'm just rooting for Ken when I'm saying I'm sure he has Malibu boats covered.
Yep, Malibu Boots has been featured a number of times at programs, and would encourage you to take a look. I think it's a 4-time roundtable selection, and Charlene Hansen also picked it during one of our recent successful investing webcasts. And Matt,
I'm happy that Installed Building Products is still on there, and I think in the beginning I brought LCI Industries, so even for me to have even one on here, I'm happy.
Yeah, those are good, and those certainly are companies that are poised to take advantage. Matt, you have any quick words about Green Brick Partners to kind of clarify for the audience?
Yeah, I'm kind of like in Kim's position. I'm happy to have a representative. I'd say if anyone is lobbying for or rooting for one and doesn't see it there, don't be discouraged. I was lobbying you guys last year to get Green Brick on here, and maybe it's in line with the theme that you're going to go in greater today. It wasn't quite ready, but now it's shown itself. So happy with them, and they're going full steam ahead.
Yeah, and Matt, correct me if I'm wrong, but I think that Green Brick was also kind of a transformation play where the historical data didn't match up with today's company. Is that kind of the situation we saw unfold about a year ago?
Absolutely right. In 2015, they did something like a SPAC transaction, but it was actually an operating company that was in green energy. They were growing bacteria to make biofuels, and had a huge accumulated tax loss, which is what Green Brick bought them for, essentially. So they could run a few years without paying taxes. But since that was essentially a company merger, all that data rightfully remains in the SEC database and other data sources that went out there, and it's sort of had to filter its way out, so people with at least looking 5 years back wouldn't get a head fake from that prior company.
Okay, very cool. All right, let's keep rolling on. Those are on the leaderboard right now, but I'm sure some of those will fall here in the next few days as we go through some stuff. All right, let's go ahead and get into it. This is from the Microcap Club. They call it the Leadership Summit. It actually took place in Chicago. I'm going to show you at the end a number of companies that we will be digging in a little bit deeper on. But again, Brian Feraldi, if you want more biographic information on him, you can actually go to his website. He has a number of columns that he has written over the years for Motley Fool. And in fact, we have featured a number of his columns at Manifest Investing as they struck a chord and just seemed like the way I would put it is I think he thinks like we do. And that's kind of cool. After I listened to the presentation the first time, my first reaction was, wow, I wish I'd have said that. He basically hit on some themes that really are challenging mysteries, at least they have been for me, for quite some time, trying to communicate them and work to develop them and understand them with our audiences and our community. And I couldn't agree more with this note. I'm going to show you towards the end where you can find this. You can also find it on the Manifest Investing website, and we're going to show you the place on YouTube. He really has touched on an area that I think challenges a number of investors, and all of us here today will probably expound on that thought. So let's go ahead and get underway. Basically, what it comes down to is Brian is a very capable long-term investor, and he doesn't ignore PE ratios. That's kind of a playful use of the title. But what we're going to basically talk about is there's a time and a place for PE ratios, and there's no one size fits all when it comes to doing the analysis of investment opportunities. And what he basically confessed in the presentation is that, looking in the early days of Amazon or Salesforce or Netflix, he would see a PE above 20 and he would just, basically ring the gong on it and toss it into the wastebasket. And basically the PEs got in the way. And I have witnessed this so many times in working with some of the finest minds in the better investing community, some of the gurus over the years that really mangle this concept. And I think it's important to basically take a deep breath and just think your way through, what is being described. So he's basically saying, I'm missing out on way too many of opportunities. And I was reminded, some of you will actually remember this. I wrote a column many years ago where I basically went back and took a look at Microsoft pretty close to their formation date, and basically made the statement that using traditional stock analysis methods back to the early stage days of Microsoft, the company was never in the buy zone. And we just know instinctively, just common sense, that can't be true. There were times when Microsoft had to be attractive as an investment. I mean, it's gone through its cycles, it's gone through its challenges, all that kind of stuff, but there had to be times when Microsoft was attractive and a traditional, stock selection guide or stock study was perhaps misleading us a bit. And I'll try to dig up that article and share it. Unfortunately, many of the old articles at the Better Investing website are no longer there, but I will try to find it because I think it really makes that point. Here, just to kind of ring home a concept, this is from Brian's presentation where he talks about just the necessity, especially when you're talking about long-term investing, to pay appropriate levels of attention to the top line. Tom O'Hare used to talk about this all the time. That really is the straw that stirs the drink, especially when you're talking about true long-term time horizons. It really becomes overpowering with respect to how much attention, it could even use the word faith, that the company is going to exploit that field of opportunity and grow sales effectively and make an appropriate profit as they do it. And so again, for longer term time frames, this is actually flies in the face of some of the other stuff we've talked about over the years. But PEs being more important perhaps for that 1 year window. I'm not sure I buy into that. I need to chew on that some more. But what I want you to think about is we're going to go into it towards the end of the session here today. The numerator of the projected return on value is precisely what is shown on the right-hand side of the slide. It's an emphasis on the sales and profit expectations for the company that you study, and it's a carefully formed output, the same output that you cover with Section 1 and Section 2A of NAIC or Better Investing Stock Selection Guide. So it really does resonate and ring consistent. All right. So you guys jump in wherever you'd like to. I mean, the subject is the S-curve. And my take on this one is, again, we've covered this. Anybody who's been investing for a while understands that companies have life cycles where they build out and grow. And that important break-even point we have talked about, we refer to it as launchpad investing. We attribute the discovery of investing in a company very close to this break-even point as a broad asset concept. And they've won our groundhog contest 3 times by picking companies that are very close to this point in their life cycle. So it can be a very powerful thing. And the point that, he goes through a number of slides, but again, I come back to this notion that one size doesn't fit all. Sometimes PE ratios work better than others. And this is kind of the bottom line. When you're dealing with core companies and companies that are in this end of this section of the graph, this is where core lives, in this zone, and you can rely on PE ratios. And then, as Ken likes to point out, PE ratios probably in combination with that projected return on value that we're going to talk about. And then if you want to talk about stuff over here, you're in the non-core zone. So we have yet another way to delineate whether a company is core or non-core, and it's kind of where it fits on this curve. And I think it's an important thing to to capture and explore. Your thoughts, Sean, as you think through some of the more energetic.
Oh yeah, I've got tons of thoughts. I got tons of thoughts going through my head. I'm curious how, like, we usually have a percentage of what we want our portfolio to be like, with core and non-core holdings. I'm curious how much what we're going to be discussing here is going to may or may not be changing that.
Oh, I don't think you need to change it. I mean, it's typically a 75-25 or 80-20, and it really is a function of risk tolerance and adventurousness of an individual investor. The time I've spent with you, yours is probably closer to 40-60 or 50-50. That's okay. For those of you that can read between the lines, Sean is a young person, so that can make all the difference too. Kim, your thoughts?
Well, I was going to say for myself, I mean, I have a few of these in my portfolio, and the thing I've learned the hard way is you have great volatility in them, and as they go up, it's wonderful when they start getting a larger and larger portion of your portfolio, and there's nothing wrong with taking off a few layers of the onion, as I say it, because I'm not quite ready to have 40% of my portfolio one stock, which is a huge growth stock. Can't do it.
Right. And Matt, what are your thoughts on the subject?
Well, I think, and we were chatting about it a little bit before, I think it's key to remember, just like a lot of hard things in investing, there's two decisions to make here, right? Is to identify those early companies that will hit the hyper growth period, and then also understanding when they might turn to maturity. And to Kim's point, it's you definitely have to manage your portfolio, but you also want to ride it as far as you can without experiencing some PE compression toward the end. And while it doesn't exactly fit the type of high growth we talk about, if you think about a retailer, those are pretty easy to see when they're going to mature, right? You see constantly where someone comes out with a new, whatever it's a new restaurant, new concept, and then they build across the nation, right? Think about the discussion of Ollie's. I forget what form it was. We were talking about that, where Ollie's is now and where they're not.
Yeah, right here.
Right? They're clear places where they can sort of step and repeat, and they can use the store growth to boost their revenue in addition to same store growth. And you can follow the company and see when are they going to get to all 50 states, or will they go international or not. And if not, then they're left with same store sales and they get into level 4 in the maturity phase. With tech companies, it's harder to do because you have to keep an eye on competitors. You have to keep an eye on the relevance of their technology. But I think that it's not just identifying when they get on the ride, but when they're going to get off.
Yeah, and I'll just underscore that. Maybe we do have a session here for too much longer on the concept of terminal velocity, the way that S&P or whatever they are today, CFRA, talks about companies. Terminal velocity when you reach that saturation point, and what some companies have done about it to avoid it. It's a good topic. So anyhow, core versus non-core, important consideration, and just this notion that PE is a whole lot less effective for some of the non-core stuff that we're talking about here. All right. Just to make the point, Brian basically says his investing success vista basically took a quantum leap in basically leaning on the work of people like David Gardner and others to focus on quality first, and then maybe open up that valuation filter to accommodate the Netflixes and the Five Belows and those type of companies, and learn how to watch them. Then he basically makes the point that he really considers, although PE ratio is important, current PE ratio is important, there's a whole lot of other things that he thinks probably have more influence on his decision making. So there you have it. All right, one of the things that came out of the presentation that I found kind of fascinating was his collection of topics. This is something that I wish I had this slide or a similar slide when Ken and I did theme-based investing at the most recent Successful Investing Conference, but this is some pretty cool stuff. And Sean actually took it and highlighted the stuff that he thinks is pretty cool. So Sean, what kind of grabbed you about all of this?
Well, something that rather surprised me is he talks about innovation and how it'll affect those future values of these growth companies. But some of this stuff isn't as old as, or isn't as new as we think it is. Software as a service isn't relatively new. Microsoft, Amazon, they've all been doing this stuff before, but yet he's still looking at it as an innovative thing. So that's something I thought that was rather interesting, that he's still taking some old products and seeing how these new companies can make that service better. There's some other ones in here that I really liked was big data. On the bottom left there on the green, I added some additional ones that I thought could be included into this. With big data, there's also big storage. And there are definitely companies out there that are breaking into this sector. Switch is one of them, and that are doing this storage and how to properly store that data, because you have to put it somewhere. Even though storage is becoming cheap, it still needs to be put somewhere. And some companies are definitely finding the land and how to properly store them. So there's some great and wonderful things on here. I love the online learning that's becoming big. Some of them are a bit overlapping. He has machine learning just below society and the green and the blue there, but he also has AI and machine learning. They can be used interchangeably, but it's definitely some wonderful things that he has here. I just wanted to expand on it more, and my goal is eventually to make this as you just click on software as a service, and then you say, okay, well, what companies fit software as a service? And it would just give you a list of brand new companies that are up and coming. And hopefully we can do some analysis on those companies and find out which ones are going to be the big winners.
Yeah, we might take a couple here over the next 19 days and actually demonstrate trying to kick out a discovered company as a result of digging into one of these themes. Kim, I'm seeing all kinds of electronic payments and stuff on here. What are your thoughts on some of these yellow?
Well, that's exactly what I'm thinking of electronic payments and electronic sports and online sports betting. Both of these areas is because we have so much more betting to be available, and you've got PayPal and you've got Square and you've got all the others. And then now you've got the buy now, pay later, and they're all getting into it. And PayPal was the first one that was getting into being able to do cryptocurrency online. So you're going to have so many different companies. There'll be a lot of weeding out and combination of them because you're going to have consolidation. And which ones will rise to the top? That'll be interesting. And the other thing that's interesting for me is where you also look into in the book I'm reading right now, it talks about machine learning as well as AI and how it could help the individual person, and also how it's going to affect financial markets. Because right now, if you think about it, we have all these algorithms who are bringing stocks to the top, and it's not an individual person that's doing them. But as an individual person, we have to recognize what we can do to be as profitable. Like if the algorithm starts selling off something and then it gets oversold, and where, Mark, you've shown where the RSI is less than 30 but less than 20, and how that can be something that they're not looking at, and we can make profit off of that.
Yeah, taking advantage of the rhinos could be cool.
Exactly.
All right, Matt, I'm sure this is your first look at this list. Anything grab you as a area that you would take and dig into in search of opportunity?
Yeah, a couple of things, Mark. It's a really good list. First, I have to really compliment on the addition of NFT. So non-fungible tokens, and you hear about these as cutesy things, right? Digital artwork or sports clips that they don't own the copyright on, but they have a copy of it. But if you think about the idea of a digital thing that is unique in the world, to me, that says identity, right? You look at just how many breaches of major systems we've had in the last 2 weeks, and think about how difficult or how many hoops you have to go through to maintain the very old paradigm of ID and password. And then you get into two-factor authentication, all these things to try and prove who you are so you can access what you want. I really think that has the potential. If you imagine that your driver's license might be your NFT, just to be able to prove without a doubt that you're who you are, and let's say impossible at the moment, but very difficult to copy. Even if someone has a copy of it, they can't replicate who you are, right? So really addresses a lot of issues for an ID password world. Although again, we're still in the cutesy phase. No one's really applied it to that big a problem. The other thing to build on what Sean said about data storage next to esports is hologram. So a lot of the technologies we have today, whether it's a disk or a chip, people don't realize those are planes. Those are only in 2 dimensions. In terms of a chip, it's the analogy is hard to do, but if you imagine that the world's highest building is about 30 stories tall, and what could we do if we could make a 200-story tall building? And so the technologies that go into holograms, when applied to physical things, not just, people think of holograms as an evolution of TV, that we would just see things. But there's been a lot, there have been technologies in the lab for over a decade to get those 2D things into 3D. But the demand is really coming through. So people need cloud computing, and big data is driving more performance. Of course, there's a lot of ecological concerns that want lower energy needs, and everyone needs it, right? Everything is digital. Everything uses technology to drive it. So I think that that is a place to look at for the technologies. And so I'm thinking like the underlying patents, not even the people who are going to make it, but the people are like Qualcomm's position in cell phone technology. They're gonna let everybody use what you need to get the sort of next leap in computing performance.
Absolutely. Good stuff. And I don't know if anybody out in the audience knows this one. I have to look it up. Silvio Pasture. That's one I'm going to have to look up and understand what in the world he's talking about. And I love it when somebody brings something like that I can learn more about. So we'll be coming back to this, and I'm sure a number of these are going to actually prompt Ken into some stuff too. So thanks, Sean. Appreciate it. And thanks to Brian for Aldi. All right, so let's go ahead.
He was the inspiration behind all of it. So
yeah. All right, let's go ahead and actually get away from the theory, that stupid S-curve that's just a theory, and talk about reality and look at some empirical results. So we're looking at a company which basically opened their doors back in 1995, and you're looking at their sales results and their sales forecast for 2021, 22, and 25 on here. And this is one of those companies that basically is taking off and certainly reaching that hyper-growth phase. And it's pretty clear from the chart with actual data that this has and can be done. So one of our major advantages as a community of investors is we take that somewhat tough to read chart. I mean, it definitely shows the ramp and the slope up, and we basically convert it using exponential graph paper. The top one was what was on this is the previous page, and we convert it to exponential graph paper, which basically enables us to examine the growth of this particular company. And you can see that going all the way back to the year 2000, this company has had a 25 to 30% growth rate, and they are basically expected to continue that. So 25 to 30%, pretty much straight line situation with a little bit of wobble to it, but we look at this company, and it certainly qualifies for eligibility for up, straight, and parallel. So that's the top line, and again, that's the one that we probably have the most confidence in as we build our forecasts and our deeper understanding of companies. And again, looking at it through the same type of exponential presentation that is done on a value line company report or the front side of a stock selection guide can be most helpful. Here's a look at the sales on top and the earnings on the bottom. And this particular company floated around very close to zero earnings, in some cases negative earnings, for the better part of 20 years until they had their breakout, their tipping point, which is pretty obvious here, 7 or 8 years ago, and they basically have liftoff. Again, this is linear scale, so we're looking at the ramp and that sort of thing, and there obviously are some moments of turbulence there. So how do we look at this company? Through our tools. Here's the stock price. Look at the stock prices there in the early years, the turbulence that I believe Kim, the turbulence and volatility that was mentioning about some early stage companies. You had some pretty wild opportunities to get into this company if you had a strong stomach. Even if you didn't, there was plenty of opportunity as these years passed by for a number of things. We're going to actually look at some specific examples. And again, just making the point that the earnings were a bit of a challenge for a long time for whatever reason. And it turns out they had a good reason, but it's there in black and white. And basically, when you take the price in that center chart and compare it to the earnings, you're talking about a PE ratio. And a company this young and this expansive and growing typically can have a PE ratio profile that looks just like this one. And that's pretty erratic, pretty explosive. You talk about companies like Netflix and others that, people will say, well, geez, it has a PE of 800. Brian Feraldi does a great job of explaining that, you could have afforded to pay a PE of 400 for Salesforce 10 years ago, and he'd have been just fine. I'd encourage you to go and listen very carefully to what he has to say. This particular company has actually appears to be settled in and headed for an average PE of somewhere around 40. That's still too high for many of us. And we see a lot of turbulence and challenging nature in trying to build out a forecast using a PE ratio, and that's fair. It's been everything that you could imagine with turbulence. All right, here's, in the case of this company, and this kind of gets back to what Matt was saying about, as the company's emerging and they're coming through their investing stage and they're getting into that realm of operation where they're approaching the tipping point and breaking through to profitability, as is shown here. If they stumble, and that's what's shown right here, if they stumble a little bit after breaking out, and then they more than stumbled here, they actually hit a bit of a brick wall again. That's what drives the rhinos and many investors crazy. And the price gets absolutely pummeled when that happens. It's especially true in biotech. If you have a company that's in biotech and is coming out and they hit one of these speed bumps or brick walls, they just get massacred. And in this particular company, the institutional analysts, who we refer to as rhinos, the rhinos would just beat them senseless at their quarterly reports. And you can see that since that last moment in time, they have seemed to have stabilized. And again, they kind of seem to be reaching somewhat of a more mature level when it comes to the projected net margins for the company, somewhere in that 6 to 8% range. So, we don't know if it'll continue. We go back and look at this, and you have to acknowledge that, for whatever reason, it fell off back then. Could that happen again? You have to basically include that in your analysis of a company like this. So by now, you guys probably all know this is Amazon, and that's the PE ratios up at the top. And one of the things that I wanted to point out, and we've talked about this, we went back a year ago, we talked about Tesla. We may have talked about Netflix in a little bit, but what we are going to cover here in greater detail is companies like Tesla, Netflix, Under Armour is one that really comes to mind for me. But in this case, here's Amazon. And here's that projected return on value, which I would argue actually crosses more dimensions than a PE ratio all by itself. We've talked about this a number of times on some of the bull sessions. So this again, I believe, shows it in pretty stark relief that you had these periods of fairly decent opportunity to go ahead and accumulate. These are David Gardner's actual purchases at the Motley Fool for Rule Breakers and for the Stock Advisor newsletter. And I wish I could say that I own shares of Amazon at $15. Can you imagine? I mean, it probably goes up $30 in a given day. You know, twice his original commitment, up and down on one day to the next. But notice the total returns and the annualized relative returns on those 3 lots. Pretty cool. And again, when PEs were a little bit tough to provide any guidance, I just want to argue, from the rooftops, that there were periods in time that the projected return on value was probably helpful. So again, I would encourage you.
Those returns are Bitcoin level returns almost.
Yeah. Look at that 212 bagger from the first. I mean, many of us are thrilled to have a 10 bagger, right? So pretty astounding. Any other thoughts on this, guys?
I think the other thing, I don't know how helpful this is. I can't generalize this for this class of stocks, but you look at the stumble that Amazon had, and you can see it in the top graph, because 2015 goes away because it's not price to earnings, it's price to deficit. That is not in a recession, right? So it's a self-inflicted wound of some kind. But that would be a point that if I was an owner and I was stopping to think about it, even as the price was falling, presumably, was this a systemic issue, or was it simply a stumble that I watch to see if they'll think their way out of it?
You call that buying the dip.
Did they buy something?
I actually don't know specifically what they did. It'd be interesting to look at.
Yeah, but it's not like they were collateralizing real estate in 2007 or something like that, which is okay. You were a creature of the bubble, and so then you are going to die, or all the .coms, right? They've survived a lot, and they had a stumble, but you'd think they have some resilience looking at the history they had generated until then.
If I had to make an educated guess, Matt, that you probably, what you're looking at there is the ramping up of their web services and that kind of stuff, because they made a tremendous investment back somewhere in that time frame. It actually goes with Sean's multicolored chart a few charts ago. They, for those that don't know it, I believe that their profitability is the biggest in web services. Is that correct?
Yeah, I think so.
It's definitely highest percentage. I think it may even be majority, but it's definitely overrepresented.
And I know they were entrenching and getting ready for that, in addition to all the other infrastructure that they had to do. So again, you go back to that graph. The growth has been fairly consistent, and you can do a lot with that type of graph. And I wouldn't be the least bit surprised to see them land in a mature projected net margin range in that neighborhood where they're barking around these days. Just for fun, I went back to check some previous work by Brian Feraldi. You can see here's an article that he participated in for the Motley Fool. And Brian picked Inspire Medical Systems, which we'll talk about here in a second. Planet 13 is a cannabis company, fairly early stage cannabis company. And Fly Leasing, Matt, is that one of the companies that you track in the aeronautical?
Yeah, a fairly volatile competitor of Air Lease, yes.
Okay, so Fly Leasing. So you can actually go back and read more at the link at the bottom. But what I found interesting, again, this is a sleep apnea company. I wasn't aware of it. The CPAP machines are kind of cumbersome, and many of the patients don't actually use them. You can see 35% kind of give up on them. They basically have come up with a solution that's a little bit more desirable on the end user side. And back in 2019, he was talking about this company growing, obviously greater than 30% per year. And they basically have a very interesting field of opportunity in direct competition with that other company that we have tracked for a number of years. And lo and behold, I didn't know this, but Inspire Medical has been added to the standard edition at Value Line. Still very much early stage. No ifs, ands, or buts. They don't have positive earnings yet. And we'll talk about that a little bit more in a second. But they do seem to be making progress, and they're penetrating into again, this field of opportunity that they have. From the date that Brian actually brought the article at the Motley Fool, that's his annualized rate of return. So he gets a gold star for this one, beating the market by 58 percentage points. That's per year since actually bringing it. And so that would have been back in this time frame here. And I assume he's still interested. There was quite a storm here with recession and the stuff that went on there. And there's a little bit of a pullback. It actually peaked out at 252, a little bit of a pullback into the high 100s. It's actually back at, I believe, 218 today. So here's a look at the company. Again, not a lot of operating history, but what we're looking for is that company, much like Amazon 20 years ago, that is showing a promising outlook at the top line. You can see that the stock price has followed pretty carefully. They still do not have earnings, but the earnings definitely seem to be headed in the right direction. When you look at it from the perspective of net margin, you can actually build a case for a company like this in the medical device field operating in that 15 to 20% net margin arena. So, if you believe in the company, and he makes the point, Brian Feraldi makes the point in the presentation, it's a little bit of hope, it's a little bit of guessing, but it can be an educated guess. If you really believe that the company is well managed and heading for, that zone of 15 to 20% net margins, you can establish a projected return on value and come up with an expectation for the company. Now, I don't think it's on sale today, considering it's come back from the low 100s to the low 200s fairly rapidly, but it's an example of the type of company. Again, keep in mind that he's back into this over 2 years ago with his opening position. So take a closer look. That one seems to be firing away, and we'll be watching that more carefully. So again, we're going to be covering the balance of these sources over the next couple of weeks, and just encourage you guys to rejoin us and check in. By the way, this is David Gardner. We've used his name in vain a few times here today. On the left, along with Brother Tom. All right, as I was saying, those of you out there that would like to access the article by Brian, it's not an article, it's a webcast by Brian Feraldi. By the way, notice that he's got 5,000 views in 6 days. You can actually go to this page at YouTube, Microcap Club. And one of the other points, I've actually looked at a number of these, but these are the actual company presentations from the Microcap Club Summit. And I'm going to actually be making sure that we take a look and pre-screen these for any possibility that they qualify for our best small companies for 2022. This one rings a bell a little bit with me. Need to go back and look. Sonara MedTech, but we will be looking at all these. Altigen also is one that I believe piqued a little bit of interest, but we'll go back and take a closer look. And then we've talked about this a few times at Manifest. This is an awesome presentation by David with respect to rule breaker investing, where he clearly has inspired Brian. He's inspired us, and we're certainly grateful that Amazon is in the roundtable tracking portfolio, along with a few others that certainly qualify in that class of investing. All right, other places to find interesting ideas, and this is one that you guys aren't going to believe, because I've actually had a Reddit account for like 10 years. And I got in and I actually tried to make a contribution not too long ago. And Sean, you're going to have to defend these guys, because the response I got back was, "Nice try, boomer."
Yeah, they're not the most pleasant people to be around sometimes. But that's definitely an online culture thing that you got to get used to. I grew up in the Xbox days where it was nothing but cursing, and a lot of stuff has been said about my mom online.
Oh man.
But yeah, it's something that you just get used to. Unfortunately, I can't defend the culture, but at some point though, there are some good ideas that do get through the weeds here, and some of the ones what I find interesting is like this one here. The Reddit has a bunch of subreddits below it. So in this case, this is Fluent in Finance, but there are definitely some ideas out there that are gaining some traction amongst the online community, and including it's even reaching Manifest, or Manifest found out about it first. But this particular poster saw that Love, Love, some wearable tech or clothing items, but which I believe Manifest Investing has also been looking at too, right, Mark?
Yeah, we've covered it. It's actually the company's Lovesac, Lovesac, and that's the it's predominantly furniture, but they almost made our list last year, and it comes very close this year. So it obviously survives a fairly aggressive screen for very high growth rate, very early stage. But some of those other companies are interesting too. That ATER could be something. The other one at the bottom is probably a little bit early stage, but some of these are amongst some of the more successful smaller company investments over the last couple of years.
Mm-hmm.
So,
but a lot of these are following that chart as well. Beyond Meat, BYND, Beyond Meat is a plant-based company that's basically has vegetarian and vegan products, and as that becomes more and more mainstream, that company's going to start to grow real fast. Especially, I think they even have the Beyond Burger. I think they're the company that has Beyond Burger with Burger King.
that's correct.
So there's definitely a lot of growth that's available right there for them. But these companies are starting to show up online, and they're definitely worth looking into.
And many of those are going to qualify as early stage and that type of stuff. And Beyond Meat's one of the poster children for when it first came out. The PE was 800 or something along that line. And the thing you have to know about the rhinos is they're lazy. They're smart, but they're lazy. And a lot of times they'll just kick out that PE of 800. And again, I would encourage all of you to basically really chew on Feraldi and David Gardner's words, and recognize that there are times when the PE doesn't really matter. It's not perhaps even relevant in deciding about the attractiveness of a company like that. So let's talk for just a minute. I just want to go through a fairly rapid reminder what this projected return on value is, and in honor of Sean and Halloween and apparently Kim. Kim says that chocolate's a good thing. And
every woman likes chocolate.
Thought we'd spend a moment with Hershey and do a quick calculation of the projected return on value, so you get a flavor for what that's about, no pun intended. Projected return on value, again, as the math says here, it's the projected net income. Again, that would be the output of a Section 1 and a Section 2A stock selection guide effort during a stock study. What is the projected net income 5 years out? And when we take that, the expectation of what that can be, and divide that by the enterprise value. So let's tackle the numerator first, the projected net income. One of the easiest ways to come up with it is to take, there are a few places where you can look it up, but I like to take the results of my study and find that long-term earnings per share estimate. And in this case, I'm using value line. Now keep in mind that value line is a shorter time horizon, basically 4 years instead of 5. So it's going to have some conservatism built into it, but basically grabbing that 805 down right off the value line sheet, and then dividing that by 1 minus the tax rate. And those of you that have been doing stock studies manually for years recognize that formula as, basically part and parcel of Section 2A of a stock selection guide. All right, so you basically take that 805, divide by 1 minus the tax rate, again converting the 18% to 0.18, and you have a projected net income per share of $9.82, in this case 4 years out, but again, we're doing this with crayons, so we're basically looking at $9.82, maybe $10 5 years from now for projected net income. So that's one place that you can find them. We'll demonstrate other places to find this stuff. And by the way, the caveat is all of these figures are going to be on the next release of the Manifest Investing Company Reports page. Here is the denominator and basically the enterprise value. We define the enterprise value as stock price plus total liabilities, and that's per share, minus the cash, which is basically cash in the wallet per share. That's a little different. If you just look up enterprise value online, they're probably going to be using long-term debt instead of total liabilities, and that will be a different number. So if you look it up directly without calculating it, you may find a different number. We think that's a little bit less informative. Joel Greenblatt would use total debt their long-term debt there. And, I don't know which one is functionally more accurate, but I really like the notion of total liabilities, all the current liabilities plus the long-term debt. Everything is in there, so you don't have to worry about the mix between the two messing things up and making things confusing. So the enterprise value in this case, again, you just pull the stock price from your favorite source, and then you want to take the total liabilities. In this case, I've taken it from Morningstar. It's denominated in billions, so you have to switch it to millions, and then divide by the number of shares outstanding in both cases for the total liabilities and for the cash. Be very careful when you're doing these calculations with your units, because you can get some haywire results if you're not careful with your units. But in this case, the enterprise value is approximately $200. So what that leads you to is a projected net income of $982, call it $10. Enterprise value of $201.56, call that $200. You're basically talking about a projected return on value of approximately 5%. Now, if you go through and look at Manifest, we're actually using a full 5-year time horizon. The number is going to be about 5.5, 5.3 to 5.5. But again, those are in the same realm. And it basically falls right in here along with most companies. So my conclusion would be that the projected return on value for Hershey's is squarely in the hold zone, basically matching the average company out there right now. So pretty quick demonstration of where you can find some of those numbers. We'll demonstrate that for a few companies here over the next few weeks also. And again, it will be in the next version of Manifest. Let's go ahead and wrap up with just a quick summary of some of the companies that are on the short list right now. Just can leave that with you if you want to dig into any of these and criticize or audit or whatever you can do. Again, if you can bring one that can bump one of these, appreciate that too. This is the
one question, Mark.
Yes, sir.
Robert Kellogg brought this up before when we were looking at the small cap companies. Just bringing a caution that we really shouldn't have any company doing business primarily in China, given the challenges to the business environment there. Are there any in the list that are?
We actually have thrown out a couple, but this one is purely Chinese, so that is going to be a subject of great debate as Halloween approaches. That's obviously a hotel and resort firm in China, and we certainly want to be careful not to have too much, as a percent of total assets in the group. So it'll be a debate. I mean, Ken is pretty much opposed. It could be right. So yeah, we are mindful of China content. All right. All right, here's your reminder that we do archive all of these presentations at YouTube under Manifest Investing. Bull sessions, the expected returns reviews, all of the roundtables, and you can see the excerpt from the most recent successful investing conference, including the stock panel, where Malibu Boats was featured. Malibu Boats is in that one too, and I think it's probably in this one here too. So Malibu has been talked about a few times. And here's that theme to target that I wish I'd had that chart for. But again, you're invited to explore. You can also subscribe, and we'll notify you anytime we post new content, educational content from one of our sessions. Another place that you can access the presentation by Brian Feraldi is in our weekly update. This weekly update, we basically kick out articles which inspire us or intrigue us or annoy us in some way. And in this case, the first one on the list for right now is Brian's presentation at the Microcap Club Summit. All right, just a quick reminder that we're going to be putting together another successful investing conference on the 10th and 11th of November. Mark your calendars. More information about that will be coming out very soon. And for those of you that are following along on the Groundhog, we've just been including this as kind of an appendix every week. My name's not on here, so I don't care. Sean, you fell off the list. I think you dropped a couple places off the list. I apologize. You're just going to have to work harder.
Thanks, Palantir.
Thanks to Palantir, huh? Big data. But I did want to point out that David Gardner, who was at probably 133rd a few months ago, has crept all the way up to 33rd on the list. It'll be interesting to watch how that behaves for the rest of the year. But Terry continues to lead. Her lead has shrunk a little bit. And Nick DiVirgilio is cranking away and is now in second place, just edging out Barb Masters. As Ken would like to point out, the Mid-Michigan Model Club continues to head up near the top of the leaderboard, and there's a couple other clubs from this area towards the top of that one too. So again, you can look at those, and we'll leave you with the view from the bluffs in Arcadia, Michigan. That's a golf course, and not too far from Traverse City and Sleeping Bear Dunes, and a nice image to capture. Any other thoughts, Kim or Sean or Matt?
So something I'm looking forward to doing here is once we got the, now that I know how to do the prove stuff, I'm looking forward to really trying to extrapolate that data and seeing if it can even be applied to older companies such as like GE, those companies that decide to pivot and change their business model a bit, seeing if you can predict those things.
Sure. I think it can actually be an interesting way to study a transformation in progress, and maybe that's something we'll get a chance to take a closer look at going ahead. Kim, are you still with us, or did you have to run off?
No, I'm here. I just love the idea of the thematic investing, and have a few ideas rolling in my head. So when I get them clarified, I'll share with everybody.
Okay, and last but not least, Matt, thanks for joining us today, and any thoughts?
Sure. No, nothing on this. Great discussion. I think it is worthy of multiple sessions as we dive into it. We do have a couple questions in the questions box. I think we can handle it after we
Okay.
wrap up the broadcast.
All right. Well, thanks for coming, everybody. We are going to continue cranking along these lines, and please let us know if there's areas where you think we should delve a little bit deeper. I have not forgotten about the idea of putting together an investable alternative, and we'll continue exploring that a little bit. Some of those have gone away over the last couple of years for investing in all 20 of the best small companies, and but we will continue to try to find that. So thanks for coming along, and we look forward to seeing you again next week. Thanks, everybody.